As the slides say, I'm Max Margenot. I'm a data scientist at Quantopian. And I'm here to talk about Thrifting Alpha, which is my clever name for trying to take a bunch of stuff that doesn't really work and trying to make it work. So instead of revitalizing tired alpha factors using Ensemble Learning, it's more attempting to revitalize tired alpha factors using Ensemble Learning. And they are quite tired indeed. Yeah. So, to begin with, a disclaimer. None of this is investment advice. This is just fun stuff that I think is fun to talk about. So who here is familiar with Quantopian? Cool. I guess the better question is, who is not familiar with Quantopian? Cool. So for those of you in the crowd who are not familiar with Quantopian, what we do is we basically provide a free platform for quantitative research and algorithm development, and we do it in such a way that we have users on the platform, and they iterate on research, and they iterate on research, and ideally at the end of it they produce some sort of algorithm. And we have institutional capital, and we allocate that, or we reach out to users who have the best algorithms and offer to allocate institutional capital to their ideas, and we license their ideas from them. So that's kind of where our incentive to have everything free is, right? Oh no. Well, the more people that you have coming together with some cool idea or another, the more people that you can get access to this sort of thing, ideally the better sorts of results you should have, right? It's essentially a portfolio construction problem. You get as many different independent signals as possible, and you try to pile them all together to get something new. So, this TV is really just not our friend today. There's going to be a fun new slide waiting for you if the TV does get started again, so stay tuned, please. And most of what the slide says is, I don't know, looks around like 15 words total, and they don't really tell you much, which is why I'm going to say stuff about the words instead. So, there's some jargon in that title, right? What's an alpha factor in the first place, right? Well, it's really more important. The important part of this is really the word factor, right? So, and this is a factor in the traditional sense of any sort of factor model in finance. So if you're familiar with the capital asset pricing model or with the Fama-French factors or anything like that, it's that exact same sort of notion there. And what I mean by alpha or risk factor, these are kind of interchangeable terms really depending on your intention of what you're going to do with that factor, which is what I hope to clarify a little bit if things ever get working. I can show you some nice mathematical notation that really doesn't clarify it that much, but who knows. So I call something an alpha factor when it's something novel. It's something interesting that you actually want. But I call something a risk factor if that's something that you don't want any part of. So classical risk factors would be things like the market, right? There is definitely some sort of return associated with the market. There is upside and downside to having a return stream that is in some way dictated by the market, but it's upside and downside that everybody's really familiar with, right? We all know that the market generally goes up on average in some way or another. So it's not really novel to have exposure to the market. It's not novel to have this new sort of setup. Whereas if you have some alternative risk premium, so some new setup that you can calculate in the same exact way that you would calculate an exposure to the market or an exposure to a Fama-French factor, if you have something like that, that's something novel, that's something interesting, that's an alpha factor, right? So I posit mainly that whenever we're talking about a factor, we're talking about a risk premium of some sort or another, right? If you have the market, well, the risk associated with the market, that begets some risk premium associated with the market itself. Just exactly what you'd calculate through the capital asset pricing model or something like that. You can extend that same exact model, the CAPM or the Fama-French. It's basically just a linear regression, right? If you see the formulation, which hopefully you will, it's essentially we express the returns of our portfolio in terms of an intercept term and a regression coefficient times the returns of the market with some extra noise. So We typically do this with returns, so we're not violating any regression assumptions, but we get this alpha term, our intercept, which is unexplained return, something novel and new that is not explained by this market coefficient and the returns of the market. Because, well, what we're basically saying is that the returns of this portfolio are made up of the returns of the market and something else that we don't really know about. So we're trying to essentially suss out exactly how much of our return is made up of the market and exactly how much of our return is made up of something that is new that we don't know about. So the next logical extension to this model is, okay, well, everything exists within the scope of the market. This is a major risk factor that we want to assess, right? So we can add more factors on top of that. Naturally, we'll always want to basically assess market risk. But there's a few other classical factors that get added onto this when we talk about the Fama-French factors, typically. And these are, in particular, small minus big, so small market cap minus big market cap, and high minus low for book-to-price ratio. And these are essentially, there is just a risk premium in some way associated with small market cap firms versus large market cap firms. And similarly, a risk premium associated with high book-to-price ratio firms and low book-to-price ratio firms. And there are many reasons that you can kind of justify this, right? There's a lot of times small market firms are more correlated with the market, or they have a very high volatility relative to other securities in the market. So these sorts of things can add risk and thus add return and kind of go from there. In this same way, we can extend the model. So instead of looking at exposure to just the market itself and high minus low and small minus big, we can look at our exposure against any other return stream. Because what we're doing is, I did tell you it was going to be small. I'm so sorry. Because what we're doing is, again, we're saying our return is made up of something novel and a bunch of other things. And these bunches of other things can be just about anything you can construct a return stream for, however you choose to build out that portfolio. So I'm going to go back to this other slide because I forgot that this was before that one, before I started talking about the CAPM and the fundamental factor models and all that good stuff. So factor modeling in general is a very general sort of field, a very general sort of term. If you've been listening at all to kind of financial talk and people starting to do more financial stuff in general, you've probably heard the words smart beta, which again, not super descriptive as far as things go. What I'm going to describe throughout this is one potential way that you could implement a smart beta strategy, or just in general a factor model of some sort or another. They're kind of interchangeable. And while they speak to this notion of, okay, well, I can compute an exposure to some return stream or another, but it says nothing about what you do with that number, which then leaves it up to whoever it is actually constructing this smart beta portfolio or the smart beta ETF to deal with it themselves. And the way that I deal with it is more in a silly way. So there's a bunch of reasons that we would actually be interested in this, right? An alpha factor or a risk factor is some alternative risk premium. And some risks we want, some risks we don't want. So if we have some collective set of risks and some collective set of portfolios that we already have, well, if we have something novel and interesting, then we might want to diversify, right? If we have some new risk premium that's totally uncorrelated with anything that we already have, we can just add it into the mix, diversifying. Uncorrelated signals, lower volatility in the overall portfolio with, ideally, a higher return. We can go from there. We can analyze risk in the same way that I kind of walked through verbally this expression of my strategy or my strategy's returns in terms of the market, right? I can take any portfolio return stream or any algorithm return stream and check to see whether it's just doing the market. And this is important, right? Because, well, if we have a notion of whether our return streams are made up of risks that everybody else knows about and nobody cares about, then we have a notion of whether our strategy in general is novel. There are much easier ways to just buy the market than to buy a strategy that has a beta exposure of 1.0. I could just go and buy SPY for no extra commission costs or anything funky going on, and we don't have to deal with it. And then ideally we increase returns whenever we diversify. So to convince you that factor modeling is a thing, besides what you've generally heard, there's this BlackRock survey. And it states that 87% of institutional investors are incorporating factors into their investment process, 67% are incorporating them into their risk management process, and 53% into investment strategies. And again, as I've explained it, factor modeling is very general. And this is just talking about factor modeling being incorporated into these various steps in a portfolio construction process. It doesn't really say anything specific about how they're using it besides that, oh, they're analyzing risk with it.
So what do the rest of 13% people do?
I'm not sure. Just not doing it, presumably. I'm not sure. But this is a relevant thing. It's here to stay, maybe. We'll see, I guess. That assertion that I'm making holds no weight whatsoever. But this is the general form that we're going to be taking. So, once we have our factors, how do we actually deal with this, right? We're going to use these exposures in some way to create a portfolio. And most factors that you can deal with or can cavort around with are going to fall under 5 main headers. And these are value, momentum, quality, volatility, and growth. And again, general terms, not being real specific about what they mean, right? Value kind of implies that, well, we're going to be buying high-value things and probably shorting low-value things. Momentum is kind of a classic investment strategy. And, well, depending on the context, it's considered either an alpha factor or risk factor, right? You can actually extend the CAPM model. The next factor after high minus low and small minus big is actually a momentum factor on top of that. Because this is a fairly common thing that people believe about the market, right? The things in motion will stay in motion. The same sort of notion as in physics. How you actually calculate whether something is going to stay in motion, well, that's, again, up to interpretation. And whether momentum is even like a valid feature of the financial markets that is novel and interesting, well, that's also up for debate, right? There are plenty of people who think that momentum is awesome and great and will do plenty. And there are also plenty of people who think that momentum is just a result of human bias and it only really exists because people think that it exists and think that it will continue to go, right? So, again, up to your interpretation. Quality will be buying things that are high quality, shorting things that are low quality, however you choose to define quality. Volatility, again, waffling back and forth on this one, right? Well, you would expect that there's going to be some sort of risk premium associated with high volatility, right? Because high volatility means high risk, which should beget higher return. But depending on the landscape of the actual market itself during any period of time, that might not be so. Say you've just gone through a crash, right? Investors in general might not be super into a high volatility sort of setup. They might be instead interested in a low volatility factor, the exact opposite of what you would expect. But maybe there's a risk premium there during different time periods. Again, up to interpretation. Then growth, we're going to go long on things or we're going to try to hold things that are going to grow and become better, and we're going to short things that are going to decrease, right? And there's definitely some intersections here. Some overlap. You could probably have a lot of things that are both quality and growth factors, because arguably something that's going to grow more in the future is of high quality or of high value. But again, they're meant to be general umbrella terms. But I think that most factors that you could come up with fall into these brackets. And that includes stuff like, oh, if I want to make some sort of sentiment factor, if I want to create something that is a portfolio of happiness itself, right? You could just go ahead and buy happiness. That might fall under, I don't know, value, maybe growth, quality. It gets a little bit more nebulous when it's something more abstract like that, depending on the model that you're using. But I don't know. I'm happy to accept all answers, really. So this is one way that you would compose a smart beta portfolio. What I'm primarily interested in is something called LongShort Equity. And as you might expect from the name, it involves going long on some equity and short on some other equity. And really this factor value is what we use in order to determine whether you go long or short. So what I do is I calculate some factor exposure. And it doesn't necessarily have to be a factor exposure, so I lied a little bit. In this case, all that I really care about, to generalize it a little bit more, is that for every security in some universe, I have a number. And that number can be a risk exposure, or that number can be a sentiment score, or that number can be something else. I'm not particularly interested as long as in some way that number is related to the strategy. That number is in some way indicative of the quality of it. And implicit in how I construct this portfolio is that that number, that value, is proportional to the expected return of that security. Because what I do is, well, I rank from lowest to highest every single security in my universe with this number, and I go long on some quantile at the top that has the highest vector values, and I go short on some quantile at the bottom that has the lowest vector values. And that's just one way to do it, right? Yes?
So I've noticed in analyzing some of the factors,
Totally.
they're not necessarily monotone. So I've seen factors where it's kind of like, kind of middle-high region will be the best. If you go all the way to the top, to the top quantile, that'll be the worst performer, and the bottom will be the worst performer. But there'll be somewhere, there'll be a sweet spot that's not at one end of the distribution.
So kind of like implicit in how I'm dealing with things is that I only really care about the extreme values. So what I'm trying to do is I'm trying to construct something where the edges are what matters, because those contain the highest expected return. Because I'm saying this factor value is proportional to the highest expected return. I've definitely seen factors where the stuff in the middle is higher and the edges are all negative, but the way I'm generally dealing with this is that everything besides the edge cases is noise, and I don't want to deal with it. So maybe that would be a valid way to do it. Maybe there's some way to kind of compose that factor in a nonlinear way with some other factor, take the product of a couple factors, or take a square, deal with something like that in order to try to capture that middle thing, try to get that up at the top. But that's not generally how I'm dealing with these ones in this case. Yeah, there's a lot of room to wiggle within. That's why I'm specifically defining this in this particular way. You could totally define this in another way, right? I don't even have to go short on one side, and I don't have to go long on one side. I can just go all 100% long, all 100% short. I just like dollar neutral strategies in general because, well, if you're going long on a similar number of assets and short on a similar number of assets, you're generally going to be market neutral. Yes?
For each factor, the rank, and it's market total.
So, bit of both. One factor, if I'm dealing with only one factor, then I only have to rank that one factor. But if I'm dealing with multiple factors, well, it's also up in the air how I'm going to combine those to make some sort of combined rank, which is what I'm going to be dealing with. So,
and if everybody goes to the top percentile, it's kind of risky.
yeah, I mean, like you've got a lot of long exposure in that case, right? You're definitely going to be getting some beta of some sort or another. That's why I like incorporating the short side, just to kind of balance that out, so I don't have to. Of course, depending on the sort of strategy that you're dealing with, the volatility strategies in particular tend to have a net negative market exposure or some market exposure, whether you're low volatility or high volatility. So not all strategies are market neutral, even if you compose them in such a way that they're dollar neutral. But generally, stuff ends up market neutral when you're dollar neutral. So I've been talking a little bit about this universe, so now I want to define it. Get a little bit more in depth on what I mean by a universe in general, right? Because this is all happening in the context of algorithmic trading. So I've written a bunch of code. It does a bunch of calculations on some set of stocks, and then it goes out and makes some orders. So an algorithm is basically just an applied statistical model, right? So kind of pursuant to that, the algorithm has some set of trades to be made in order to fulfill its mandate, in order to essentially be in line with the model. So if you can't make the trades that the algorithm wants to make, then you're not really enacting the model as it should be, right? If you're only getting very small fractions of trades, you're only getting the long side and the long short strategy because you can't short because you didn't actually check with your broker, that sort of thing, then you're violating the mandate of the strategy. And, well, you don't really know why it would overperform or underperform as a result, right? You could have some massive boom or some massive bust, and you can't really say anything about it one way or the other because it's doing so many different calculations, it's making so many different moves that you can't really assess it after the fact. So, I don't know, like an unexplained return is significantly spookier in general than an explained loss, right? Because if an explained drawdown, if it's in line with all the assumptions that you made in the construction of the algorithm, then that's not super worrisome at all. As long as it's still consistent, then you can analyze things given what you know about your model, given what you know about all the past performance of the model that you dealt with. Especially because if you're live trading something, right? Everything is new, everything is out of sample. When we're dealing with financial data, it's impossible to get true out of sample data until you're actually paper trading new information or live trading new information. Just because, well, the only things we can trade on are things that we've observed, which already makes it the past, right? So, it makes it hard to get actual testing stuff. So I wanted to find a universe that has sufficient liquidity. I want to make sure that every single time that I send out an order, I'm reasonably confident that it's going to get executed. So pursuant to that, we define this universe called the Q1500. We also have the Q500, and I think hanging around somewhere is the Q3000. But the basic idea is you kind of filter out all the garbage that we don't want to deal with. We filter out penny stocks, we filter out stuff that's the target of a merger and acquisition, anything that would introduce undue volatility or make it hard to execute an order, we kind of cut all that out. And then we take the top 1,500 by market cap. And if you want a little bit more details on the specific filters that go into that, because that was just a general sense of them, they're all detailed in this post on the forums called the Q500 US and the Q1500 US. I also wrote a lecture on universe selection in general that steps through this process of filtering down 8,800 equities to a reasonable basis of 500 to 1,500 securities. So, my point with this overall is that predicting prices is very difficult. If I have a long basket that I'm buying and a short basket that I'm shorting, then all that I care about is whether these baskets spread apart or get closer together. I am totally skipping this problem of directly predicting prices by thinking that I have some notion of these things are better than these other things, just because it's easier to determine whether something is better than something else than it is to determine whether something is objectively good or not, or will be objectively better in the future, right? I like dealing with subjectivity, both as a person and both whenever I'm dealing with models, so this just makes it easier for me. As long as these baskets spread apart, then I don't really care whether I'm in an up market or a down market, right? As long as my short basket way underperforms my long basket when everything is underperforming, then they're going to spread further apart, and there's still going to be a return, a positive return. Yes?
And you don't mind if your short basket actually loses money because when you have a short basket canceling out against your long basket, your Sharpe ratio in general will be higher no matter what both baskets do in absolute return, as long as the composite of the two baskets is positive and Sharpe ratio is high enough.
Yeah, as long as this composite is positive, that's all that I really care about. As long as they're spreading further apart. So I'm capturing this relative value here, and this is making more explicit this notion that I care about the expected return, that my factor value is proportional to the expected return of a given basket. Just because, well, this is putting my ranking scheme to the test. All the things in the long basket have a high factor value, and all the things in the short basket have a very low factor value. So as long as that is consistent, as long as there is this monotonic relationship between factor value and expected return, higher factor value correlates with higher expected return, lower factor value corresponds with lower expected return, then I'm going to make this. This is going to work. So this is an example definition of a factor, and it gets even smaller for those of you in the back. But this is just a momentum factor that I've defined using our pipeline API. And I've taken some inputs, and I have some window length over the past year, and I define a computation. So the way the pipeline is set up, we define a set of filters that we want to filter on a universe, and we define a computation that we want to perform for every single security in that universe. In this case, this computation is one way to deal with momentum that I've called advanced momentum. So what I'm doing is I'm taking the 11-month return from the beginning of this past month, and I'm subtracting out this past month's return. And then I'm standardizing by the returns of about half a year. My basic hypothesis here is, okay, well, there's a lot of research that says that there are long-term momentum trends. Momentum is a long-term factor. But there's also this risk of a short-term reversal. So I'm penalizing this long-term aspect by the short-term aspect, and ideally, I get something better. And if I actually run this through a different package that we put together called AlphaLens, this is what I get. This is the mean return by quantile. I've separated it into thirds, so 33%, 66% are my quantiles. And I'm looking at 1, 5, 10, and 30-day horizon. So the way that this 1, 5, 10, and 30-day setup is put together is, well, today, AlphaLens is just for evaluating a signal. So it's essentially today, if I had magically held all these securities yesterday, what's the return? If I had magically held all the securities 5 days ago, what's the return? 10, 30 days, so on and so forth. And you can input as many days for the timescale as you want, just to try to see if, well, this higher factor value truly is predictive of a higher return for your basket, and over what timescale. So the way I define this momentum factor, I'm dealing with stuff on a yearly basis. I'm piping in a year's worth of return. And one thing I guess I never really covered when we deal with a long-short equity strategy is, well, when do we rebalance it, right? You can't be continuously making trades in continuous time because you need to say, hey, broker, I would like to buy, or hey, broker, I would like to sell. I would like to close out these positions. I would like to open up new positions. So you need to sort of decide either in your research step or somewhere else whether one time scale versus another is reasonable. So even though this 30-day time scale is essentially the exact opposite of what I want, because this I want to be way negative and this I want to be way positive, a one-day time scale really doesn't make sense when I'm dealing with a year's worth of data. So I'm just going to disregard that. And then a week, 2 weeks, maybe those are definitely more viable than a single day, but with the scope of the other 5 factors that I'm dealing with, I want everything to be on a 30-day time scale. So even though it's sad and upset and very, very tired, I'm just going to roll with it anyway, the 30-day time scale. And this is what that portfolio looks like. If we were to run it over a 30-day forward period, it does OK for a while, and then it really doesn't. And this is what each individual quantile looks like when we look at the cumulative return for a given quantile. So these are all components of an AlphaLens tear sheet, which is an open source package that I'll link at the end. But these are 3 of the main things that we'd want to look at. Besides some notions of turnover and some notions of some other things, we have some baskets. We want them to go up and to the right. We want these to spread out real wide. We don't want any sort of crossover, so ignore those. We don't want to be dealing with those at all. But this is where we want to see these spreading apart. The first and the third quantiles, and then this one is just a terrible color for this screen. There's this yellow quantile here that's just kind of hanging out in a positive sense. So here's your middle quantile overperforming either of the edge quantiles. So here's some other factors, and for those of you in the back who can't see, they all look terrible. Yeah, none of them go just straight up and to the right. They're all wavy, some of them drop. This one is just down and to the right, which is the mirror image of what I want to deal with. But these are the factors that I'm working with. We're in rough shape. So again, this image is just to kind of dictate the workflow that we're dealing with here. So I have some set of data. In this particular case, what I'm dealing with is pricing data and fundamentals data. I've defined some universe, namely the Q500 or the Q1500, on that data to filter it down and see what I find useful and see what's interesting. Within the context of that universe, I've defined a set of alpha factors that I want to buy in some way or another. Because every time that you construct a long-short equity portfolio in this way, you're essentially constructing this alternative risk premium. You're constructing an alternative asset that is the embodiment of that. I'm constructing momentum. I'm constructing net income margin. I'm constructing these just because I'm trying to expose myself as much as possible to them. So in this case, I have around 6 alphas defined on this universe. and the important part of this talk is this alpha combination step. I have these 6 abstract constructed assets, these 6 abstract ways that I can rank a universe of securities, and I want to combine them in some way. I have a portfolio construction step on the universe of securities that I want to buy or sell before I even go to allocate to them in my literal portfolio construction step, which, again, I haven't really clarified, right? I could go equal weighted in a long basket or a short basket. I could go all in on the edges. It's up in the air. We'll deal with that later. And of course, we can add in other things for that. If we want to add in constraints, if we want to make sure that we're minimizing market beta or dealing with that, that's all past this portfolio construction step at the end. So what we're starting with is this alpha combination, and we'll deal with the portfolio construction later. So we can see these as individual constructed assets, and we can combine as many as we want into some large mega factor. And well, this makes sense in the context of any sort of signal aggregation or any sort of modeling, right? If we have a bunch of independent or reasonably independent signals, if we can combine them in some novel way to get something interesting, then ideally we should have a stronger overall signal at the end of it, right? It's observable even in like a multiple linear regression. You add more terms, as long as they're independent from the other terms, your regression should overall improve. Whenever you're dealing with any sort of portfolio, if you add in new independent assets to that portfolio that perform reasonably well, then ideally your portfolio overall will improve. Similarly, if we add some new alternative data set that you can construct an alternative risk premium on, well, this is something that you haven't done research on before. A strategy, a portfolio of strategies that you already have, you've iterated on some data sets. That's all in sample at this point. You've beat it, and you've beat it, and you've beat it, and you've come up with these ideas, right? If you add in a new data set with some new idea as part of it, then that's, well, highly likely to be uncorrelated compared to dealing with the same data set again. So that's the appeal of incorporating, well, I don't know, like a sentiment data set or weather data set or any of these alternative data sets that you may hear funds or investment firms of any sort talking about and trying to incorporate. This is primarily why it's interesting. And how we can actually allocate between those factors or allocate between these different risk premia is entirely up to us. So I'm going to define 2, again, general ways that we can do this, namely dynamic and static aggregation methods. With a static aggregation method, that's going to be like, well, I want some equal weighted portfolio of these. I want to go long on a momentum factor. I want to go short on a mean reversion factor. Maybe that's doing the same exact thing because, well, momentum, you expect things to go up, and mean reversion, you expect things to stay around the same. If it goes up, it's going to revert. And if you go short on a mean reversion factor, that probably means you're just doing momentum again. But again, all in how you define it, all in your interpretation of stuff. So a static aggregation is just we pick some weights and deal with it from there. A dynamic aggregation is more, well, we're changing weights based on the performance of our factors as we go. So this would be if we want to, I don't know, use some sort of ensemble learning method in order to aggregate these. But maybe implicit in this sort of dynamic aggregation is a sort of meta-momentum factor, right? Which is something that I've realized as I've given this talk more and more. Well, if you're changing the weights of certain factors based on their factor performance, presumably weighting the factors that do better and lower weighting the factors that do worse, then that's momentum on the factors themselves in some way or another, right? Because you would expect the factors that have done well in the past, or you're sort of implicitly saying or explicitly saying that the factors that have done well will continue to do well. So there's human bias in everything we do, which is really nothing new in any case. So first, I'm going to construct this static equal-weighted factor portfolio. I want to take all my factors, I'm going to standardize them, and then I'm going to add them together. And the reason I standardize them is because, well, if I'm dealing with market cap, right? Everything has a market cap value, and it's all very high. And if I compare the magnitudes of a market cap with the magnitudes of a volatility, that is just not comparable at all, right? If I add volatility of one security to its own market cap, I get no real gain there. So by standardizing it, and standardizing within each individual factor, I preserve the ranking of my universe within that factor, right? Because, well, I'm taking a given factor, I'm subtracting the mean, I'm dividing by the standard volatility to kind of squash it. Everything's still going to be in the same order, but then it's going to be comparable to all the other ones that I squashed. And that's why I care about that. Just because, well, now I can reasonably allocate between them because they're all comparable. In this particular case, I'm just adding them together, so I'm constructing an equal weighted portfolio. And this is what that looks like. Again, we're looking at the 30-day horizon, and we're real bad, which makes sense because everything was kind of down and to the right or some approximation of it. There was nothing that was all up at the same time, I'm pretty sure. Take my word for it. So that's not so good. This is the cumulative return. Again, not so good. And this is what the individual quantiles look like. And it's, all right, we're going to drop this. We're not going to deal with this specific aggregation method at all, right? So my next hypothesis is essentially that, well, maybe there's some creative new way that I can allocate between these factors, some creative new way that I can allocate between these constructed assets that will give me something interesting, or at least something that isn't that bad. Really, I want something that isn't that bad, and that's a low bar to set. So we'll probably be fine going forward. But ensemble learning is kind of based on aggregating these many different individual signals, right? We aggregate a bunch of different learning algorithms. And this is all kind of born out of the idea that it's very difficult to come up with a good training algorithm, right? Like all the factors that I constructed, you didn't see what their actual names were or anything, but these are all well-known fundamental factors. They're all well-known technical factors, or price-based factors. And none of them really do super hot, at least over the particular time period that I picked, right? There are so many ideas in the world, and so many of them just get filtered out at each step of a funnel as you're researching and ruling things out. And by the end of it, you have one idea, and then you got to actually backtest it, and it's no good whatsoever. So you have to start all over again with a new set of ideas, right? It's very bleak. In general, trying to come up with the algorithm that's going to go up and to the right consistently in a novel way that isn't just beta. So we don't just buy 30-year treasury bonds. So what I'm doing in this particular case is I'm combining a bunch of meh stuff into ideally okay stuff. Maybe that's a little optimistic. We'll see. So the way that I deal with this is essentially, well, I'm already saying that my long basket is going to go up and my short basket's going to go down, right? So I'm effectively saying I have some classifier that if I have a high factor value, a high feature, it's going to go up, and a low factor value, it's going to go down. So I can mask this as a classifier of some sort or another and turn this into a classification problem. And I'm going to do this with Debus, which is an old favorite in ensemble learning. It's tired and beat up, much like the alpha factors that we're dealing with. It has its own limitations, but it's a solid one, all things considered. So the basic implementation of Debus is that I have some set of very weak learners, something that has a 51% chance, 52% chance to get a classification right. In this particular case, the way I set this up is I'm using the scikit-learn basic implementation of Debus, which uses by default a decision tree classifier. And I take 100, 200, 1,000 individual decision trees, and I train them. So I have an individual feature value. Each of my factors is a feature, and then whether that security went up or down is my classifier at the end. So I train my decision tree on my 6 features to predict whether something's going to go up or down. And then I train another one. And then I train another one, until I've trained about 1,000 different decision trees. And I reweight between these decision trees based on which ones perform better. So some decision trees are going to do better than others, so they get a higher alpha value here. And I take this linear combination out of all of them, and I take the sign of that outcome. So because each of these classifiers is classifying as 1 or -1, what I'm essentially doing is voting yay or nay, and I'm taking the average and then saying what the majority says. And that's going to be the output, whether I think that this security is going to be up or down. And this is the new number that I'm calculating. Whenever we deal with any sort of classifier or any sort of classifying algorithm, even like a logistic regression, right? You can interpret the output instead of as a 1 or a -1 or a 1 or a 0, however you lay it out. You can interpret it as a probability. And then that gets truncated to a 1 or a -1 or a 1 or a 0 or however you feel like setting it up. So I'm going to take that probability value, and that's going to be essentially my new value. So I have this linear combination of classifiers inside this nonlinear function, the sine function here. So I mask these factors, and in particular, I'm going to train these over a month and try to predict returns or whether I'm going to be up or down a month into the future, 20 days into the future. And then I'm going to reweight these individual factors based on their aggregate performance, and ideally, I'll profit with a question mark here. We'll see what's up. So in order to test whether this is actually viable, well, I tested it first before then putting it into alpha lens and then putting it into a backtester. So I take this scikit-learn AdaBoost classifier. I take, I think it was like 6 months worth of data, or I don't remember the specifics, but I did a 50-50 train test split. I trained it on 50% of the data and tested it on the next 50% of the data. And in sample, these are real small, I get a 52% accuracy. And that's great. It's greater than 50. As long as I have some edge greater than 50% whenever I'm dealing with anything in an algorithm or in blackjack or whatever, I'll make as many different independent bets as possible, and hopefully the law of large numbers is on my side and I'll get that 2% edge, right? If you have a 51% edge, you're counting cards, you're doing whatever, you have a very minimal edge in blackjack, right? And you have $10,000, you're going to go and you're going to bet the smallest individual unit bet at as many different tables as you can, right? Because you're not going to go and say, oh, I have a 51% chance to win. I'm going to bet $10,000 on one table. That doesn't make any sense whatsoever. You want to split that down as granularly as they'll let you and then disperse it. So that's what I want to do here. And then out of sample, testing that trained classifier on the next set of data, I get a 51% accuracy. So I still have an edge. I'm still up. It's not as earth-shattering as a 52% accuracy, but I'll definitely take it. And sort of implicit in the training of these decision trees is a weighting scheme, right? I train my decision trees and I train my decision trees, and the ones that do better have different weightings that they apply to the features involved. So I can extract out these feature importances from this weighted sum of these decision trees. And over this particular case, with this trained classifier, this is the weighting. So the highest weight is to net income margin, followed by return on investment capital, followed by EBIT to assets, or earning before interest and taxes, then free cash flow yield, 3-month volatility, and my advanced momentum factor is the saddest out of all of them, which I think is actually why I put it first to discourage people off the bat. But this net income margin looks promising. But notice that all of these are positive weights. So this may be an issue going forward. We'll see. So this is what this signal looks like when I run it through alpha lens. 1, 5, 10, and 30 days all look awesome, right? We're up and to the right. That's what we care about. And again, we're staying true. We're sticking with this 30-day time scale. 30 days are great. And this is what it looks like. Not as bad as any of the individual factors or the static weighted one, right? It's definitely not terrible. It's by no means good. But it's definitely better than what we've dealt with before, right? So we're down a little bit, and then we're up, and then we end up, thankfully. And then if we look at these different quantiles, well, we start off real rough, but it seems like we're doing okay since. We don't have 2 crossovers, right? So I've evaluated the signal. Alpha lens is for evaluating a signal. But it's not enough to just have a good signal in the first place, right? There seems to be this monotonic relationship where the high AdaBoost value or high predicted probability of up or down corresponds with a high return. But I need to actually bring that into something. Like alpha lens does not in any way incorporate commissions. It doesn't incorporate slippage. And whenever we're dealing with an algorithm, well, you exist within this physical space of the market, however physical you actually want to call it, right? You need to execute orders, and In order to execute orders, you will pay a commission. And depending on whether you're an institution or an individual, that commission will vary, but you still have to pay a commission. Similarly, by being in the market, you affect the market. This is slippage. So every time you place an order, you're almost never going to execute at the price at which you place the order. There's going to be some pushback against you that's going to disadvantage you. So that's this market impact model, this slippage model. So you need to incorporate commission and slippage just to eat away at this signal and make sure that it's still good after the fact. So if we do that, we bring it to the back tester, we get negative 16% return with a 33% drawdown. So over the lifetime of this algorithm, we lost 33% of our overall capital from the beginning to the end. I think we're in a drawdown. Yeah, we're in a drawdown the entire time that we're running this algorithm. So got a negative Sharpe ratio, negative beta, negative alpha. There's nothing good about this. Yes?
Quick question. You mentioned slippage.
Yes.
But if you have relatively small investment relative to the market cap of what you're investing in,
Totally. Yeah.
wouldn't the slippage be relatively low, or you're saying that?
It varies on the size of your order. So that's why it's important to deal with your portfolio construction. So you'd want to make sure that, well, even if you've dictated that I want small bets, you need to kind of enforce that in like a portfolio optimization step. So in the implementation of this, I believe that I added like a maximum or a minimum portfolio concentration or individual stock concentration of like 5%. So I kind of enforced that. But still, even if it's small and you're making lots and lots of these small trades, there's going to be some small slippage that accumulates up. So it's still good to model it either way. And that's what that looks like. So a potential culprit is this is a turnover graph. So I took that back test and I ran it through a portfolio analysis tool that we call Pifolio. And it looks like we have like a 90% turnover every single time that we rebalance. So every month we're closing out 90% of our positions and opening up new ones. So that's not so good. And I realized like, oh, well, this is probably a problem. And then I remembered that I didn't turn slippage and commissions on. So even without slippage and commissions in this particular model, we're still performing terribly. This is the pure signal, right? So this probably speaks to some limitations of my actual implementation of this than a limitation of the signal itself, right? So the model itself, before we get into the limitations of the platform or anything else, I put in a bunch of garbage. None of those factors individually was good over the time scale that I'm looking at. So it could be a garbage in, garbage out sort of situation. So maybe if I passed in something better, I could improve the performance. When we deal with Debus as an ensemble learning method, well, Debus is incredibly sensitive to outliers. And if there's anything that has outliers, it's financial data. So maybe this is just a fool's errand in the first place, using this specific ensemble learner, right? Maybe if I used a different ensemble learner, I'd have better performance, even with bad factors. And then I could just add more decision trees into the mix, right? Debus performs better the more decision trees that you include, the more weak learners that you add in, so maybe that'll do the trick. I suspect it would be one of the other ones. But I think more importantly in this case is limitations of the specific platform that I'm using, right? So I did all of this on the Quantopian platform. Research is all done on Quantopian. It's all done using our tools. But when I'm dealing with the backtest, I have a very limited training window for a machine learning classifier in this particular case. I think what I ended up doing was trying to predict a week in advance with a month's worth of returns. So this is, I think, where the issue is coming and why we're getting so much negative stuff, because everything that I'm dealing with is based on the presumption that, well, I can train on a month or more than a month and predict the next month. But the reality of it was that I was unable to do this. So I had a very limited backtest window over which I could train even this limited condensed classifier. So maybe with some platform implementation, some platform improvements, I would be able to deal with that in the future. So this is a long list of all the tools that I dealt with. In particular, AlphaLens is our factor analysis, factor modeling package. That's available on GitHub. Pifolio is the portfolio analysis tool that I pulled that one turnover graph out of. But It has a lot more than just that, I promise. Beta exposures, Fama French exposures, some really cool notions of like a round trip. So whenever you enter into a trade, it doesn't really deal with stuff, or it doesn't really evaluate the trade in that particular set of graphs until you've entirely exit out of it. And the idea there is to, well, your algorithm entered into a trade. It has some intention with this, and by the time it closes out that position, ideally, its intention has been fulfilled. So it calculates like P&L and cool stuff over that. I recommend checking it out. It's neat. And you can run it on any return stream. In this particular case, what I did was I loaded a backtest object from developed by Zipline, which is our backtesting engine, and I loaded that into the research environment and then ran Pyfolio on that. So it's convenient in that it's all integrated on the platform, but you can deal with all that on your own local machine as well. Zipline is behind the backtester, as I said. It's awesome. Lots of people use it independent of the Quantopian platform, but that's one of the main things that we provide. Scikit-learn is a great package for machine learning, statistics, all kinds of cool classifiers and regression models. I highly recommend it. I like it. This whole presentation in general is basically drawn from the series of posts Machine Learning on Quantopian that kind of walks through the workflow of getting machine learning to work in this particular way, setting up this Ensemble Learning classifier and breaking down the individual components, probably in far more detail than I have been able to dictate here, if only because I can't remember everything that's written over the span of 3 posts. And all of this was done in our research environment, which is hosted Jupyter Notebooks, all free with a Quantopian account. And I run the Quantopian lecture series, which is a series of statistical and financial lectures, all written in Python, also all free, also all on our website for free, and also on GitHub. The repo is, instead of Zipline, Pyfolio, or AlphaLens, it's research_public, and that's where I keep all my lectures and template algorithms and stuff. That's my Twitter. I don't actually tweet. So I don't know why I even put it there. That's my email if you want to send me questions. I like statistics. I like silly ideas in general. Definitely send me an email if you have any questions. And that's a disclaimer. Just to remind you all that none of this is investment advice of any sort. And all of these slides are available on my GitHub, which is github.com/mmargenot. And that's just first name, initial, last name. And that includes both this set of slides, which I generated with Notebook Convert for a Jupyter Notebook, the notebook that I used to generate these slides, as well as a notebook that includes all of the research that I did and then distilled into the notebook to generate to the slides that I then generated the slides from. So definitely check that out. I've got a repo called Talks. This is the only one in it, so it shouldn't be too hard to find. And that's my talk. Questions?
I was just wondering, could you tell us a little bit more about yourself and what your background is, like how you know all this stuff? Do you have did you study quantitative finance in university, for example? You kind of self-taught?
Yeah, so I have a bachelor's in math, because I like math. I did a lot of theoretical math there. And then I did a master's in mathematical finance at Boston University, where I didn't really learn anything about machine learning or anything about algorithmic trading in general. I mostly learned stochastic calculus and measure theory. So everything since then has been stuff picked up.
Right, so a lot is self-taught, but you do have a formal background.
Yes, I have a formal background in math, and yes.
Okay.
Yeah, and it's just kind of iterating on top of that, building from there.
Nice. Okay.
Yeah.
Great. And then you worked for Quantopian for how long?
About a year and a half at this point.
And so your position there is like you're sort of in charge of lectures and
Yeah.
public outreach?
A little bit, yeah. They kind of go hand in hand. So like I run the lecture series that's got stuff from, hey, how do I Python? What is a mean? What is a standard deviation? To how do I do a Kalman filter? How do I do more complex stuff? So I manage that. I manage the curriculum for that, and that involves outreach, collaborating with different professors. We've got like a workshop series that we run based on those lectures. So that's part of how I get out to do stuff. And I also do research on my own at Quantopian. So I do a lot of stuff in like Bayesian models and machine learning, which I write talks on and go talk about. Because I like talking about things that I come up with, and most of the time things that I come up with don't work. And And those are the best things to talk about.
You know, I appreciated how you just admitted that, this particular thing doesn't work. Because we're here to learn about the process, the
Yeah.
specifics of whether it works or not.
Yeah, it's so much more fun that way, right?
Absolutely.
Like I could show you something that definitely would have worked had I been able to run it over the years of 1925 to 1982, but that's not really compelling. This is more recent, and even if this didn't work or wasn't particularly good in the first place, well, you can kind of go from there and build on
It's
it.
the process that matters, not the specific.
Precisely, yeah.
So I think you alluded to this when you were showing the backtest, that the model wasn't the same model as the research.
Yes.
Can you talk a little bit about how to use a trained model in a web algorithm?
So in the case where I was able, if there was a world where I was able to train it over that however so long that I wanted and predict, it would be basically identical to the research project and just research process and defining it in just with an sklearn classifier and going from there. So a little bit of what we had before was this advanced momentum factor is drawn from, well, inherits from a custom factor, which is just a way that we define a computation on the pipeline. So the factor modeling general workflow that we have very intimately involves this process called pipeline, where we define a bunch of computations, whatever those computations may be, and we run those computations on the universe that we filter down. So as long as we can describe that computation in that little compute function of the pipeline factor, then you can get the number. So in this particular case, I have a very, very long, ugly factor that takes a bunch of individual factors and trains an sklearn classifier on them and then outputs this predict probability thing. So it's basically the same thing. If you check out the stuff on my GitHub, or if you check out that series of posts, Machine Learning on Quantopian 1, 2, and 3, it's got all the code for how you cram this Debus classifier into that factor and go from there. But it's all kind of based in that.
Thanks.
No problem. Yes?
I saw you have created an ensemble of various fundamental skills.
Yeah, and a couple price-based ones as well.
Yes.
Yeah.
Have you applied defining fundamental and technical?
I did.
Which ones?
The net income margin, earnings before interest and taxes to assets. There's a 3-month volatility. Those are fundamentals, and then 3-month volatility and momentum are technical.
Oh, okay, got it.
Yeah. Yeah, so I have already done this. Yeah. Yes?
So when you were going from the factor models to like the trained set or classifiers,
Yep.
there's the 6 calculated features
Yeah.
So it's those different factors, same slot, is that like different observations?
Like,
And what period of those factors?
yeah, so the training process was predicting 20 days in advance. So whether today, 20 days in advance, it was up or down, and the feature on that day. So using that set of 6 features for a given day to predict 20 days in advance. And then you troll forward, train all your 6 features on that day to predict 20 days in advance, and so on and so forth, with this sort of rolling window.
Your observations are just all the different stuff, or all the different names?
My observations are all the different names for all the different times.
Going
Yeah.
back.
Because for every single individual day, I have around 500 securities. They each individually have a feature value and are each individually up or down. Each individually are up or down in 20 days or so. Okay.
You just inspired another question.
Cool.
Well, my next question. What's a good strategy for doing train-test split? Because I've totally made the mistake of using your randomized one, and then your data points that are close to time.
Do you mean in time series or in non-time series? In time series?
Financial time series, yeah.
Financial time series is just terrible. But the typical thing is called a walk-forward optimization generally. So you just kind of, again, troll forward, where you take a set and you train it on the next set, and then you either step to the next set and train on the one after that, or you just add the next set to that and use that to train and predict on the next, and you keep creating this big monster. So either of those two, really, because you can't really cross-validate in the same sense where you chop and chop and train random things on random other things, because then you destroy the time component.
Then you're kind of biased toward the past.
Kind of, but yeah. Yeah, all that you have is historical data, so it's really contorting cross-validation to fit within that time constraint that you have to deal with. Like if it was astronomy or something, we could just look at a different portion of the sky. But financial data, not so much. Yes?
So if we wanted to take this kind of line of thought that you've got in this book,
Yep.
what are some potential directions you might suggest? For example, one thing that you, I think a throwaway line that exists in my book was that you mentioned on the factors. And so maybe, the idea that could be that you instead of kind of static weights that you train, maybe have those weights roll over time.
So that's essentially what I've done. So every single time that I train this ensemble classifier, I'm going to have different factor weightings.
So it changes every day.
Yeah, it changes every single time that I rebalance, or every single time that I train it, and I only train it when I rebalance.
Okay.
So on each month, I'm using a different set of weights based on the past month's worth of performance.
So then my first question, what would be the next step then?
To improve upon this, or
What would be some directions that you might suggest?
not pass in garbage. So pass in better factors in the first place. Use a different classifier. Try to set things up in such a way that you can train over a longer period and predict over a longer period. Because I think, well, training over the past month, when I'm dealing with long-term factors, might not be so meaningful compared to training over 3 months, which I think would be a nice minimum to try to get up and running, and then predicting over the next month. So that I think would be a good first step. And then other factors, other ensemble learners. I think in the actual construction of this, I don't remember if I equal weighted or allocated proportional to factor weight. I don't remember if I factor weighted or equal weighted. Because all that I've really done by sorting and squashing and ensemble learning and whatever is selected what I want to go long on and what I want to go short on, right? Because the output of this ensemble learner, this prediction of whether it's going to be up or down, is my new factor value. So then I've used that to select what I'm going to do. But maybe there's a better way to then allocate amongst what I'm going to do. So that could be a factor weighting scheme, add in other constraints, reduce constraints, other sorts of things. So there's a bunch of ways that you can improve it. Yeah, part of the advantage of like a long-short equity strategy in general is that it's super moddable. You can swap in any sorts of parts that you want. It's like an engine. You can take out individual parts and replace them with the same exact part, and it should run hopefully better if that new part is better. Yes?
Did you train the model, a single model, on all the data produced within the pipeline for all the assets, or was it individual models per asset?
The way that I ended up doing it was I didn't train 6 individual models. I treated my 6 factors as features for this one model.
But you incorporated every single asset in your pipeline into...
Yeah, so I incorporate every single asset in the pipeline because each of them has some set of 6 numbers, and then I use those 6 numbers for each to predict. Yeah. You do have a question?
Yeah, just in terms of improving it.
Yeah.
Since it did do, so to say, so consistently badly,
Yeah.
wouldn't it just be possible to reverse all the...
Whether we could short an algorithm?
Right.
Yeah.
Like just short whenever it says to go long.
So I joke about that a lot, actually. And you actually almost never get this exactly the opposite. I know that there is some reasonable reason as to why you never get the exact opposite.
Because the transaction costs are negative no matter what you trade.
Right.
And
Okay.
So that eats a lot of margin. So
That's a good one.
you can't just do that.
I'm going to take that one.
I totally agree with you, except that
Yeah.
you said that one that showed the 33% drawdown was not including commissions.
Or slippage. Yeah. that was just bad predictions,
That
maybe.
case, a pure up But
Even in the case with no slippage and commissions, I still have not observed things actually doing the opposite of what you say when you put a negative sign in front. No matter how facetiously I suggest that.
no, I've also experienced that it's
Yeah.
not so simple, but I'm not quite sure why, other than that the
So
commissions
there's
drop
another,
there.
there's another longer argument is that for every X that you fall, you have to, for example, it drop by 10%, you go up by 11%, right? And so what happens is the law of accumulation actually works against you.
Right.
So that's why usually when you try to mirror like a triple short, you fail miserably, right? You never ever do that, and that causes integrity. Actually, I have a question about the Q1500.
Sure.
That's a asset that I just call from, like it's a.
Yeah, that's an object you can just pull
And
in.
has it also been screened for like the shorts being liquid enough? Like some securities may not be shortable.
Yeah.
But may not be there might not be enough volume.
I think that's one of the filters that is applied. Volume and some notion of volume is definitely incorporated into it. Again, I'm not sure of the specifics of the filters because there's a bunch of them that go into it, but that is all detailed in the post. And as well, the definition of it is essentially just a set of pipeline filters, and I think it's all in Zipline if you go check out the code base there. Yes?
Is there a process or is there a method you have created to reduce the noise? So many trades, it's not practical to have those many trades done every day.
So I'm only rebalancing once a month. Yeah, so it's not like an everyday sort of thing. Like I could rebalance every day, but that's not really faithful to my research process because I'm like, okay, well, I want this to be on a monthly basis. It doesn't really make sense to do it on a daily basis. So I'm only placing those orders on that given day.
And this algorithm and the method what you use is that filtering out, like giving you positives, like true positives, and
I don't know, maybe.
all before.
That could be another problem. I've got a lot of noisy data, so maybe the predictions are just bad. I mean, like I'm only getting a 52% or a 51, like a 1% edge on a given training set. So, sure, there might be extra noise thrown into the mix. Yeah, essentially, whether it's up or down. You could add in an up or down if you wanted to. That's more effort than I was willing to put in. You definitely could. That's another improvement that you might be able to make, whether it's going to stay within some band around the current value.
Have you tried neural networks by any chance?
Tried what?
Have you tried neural networks by any chance? That's
Kind of my I have not for this particular thing. Mostly because I don't know. In this particular case, I think it makes sense to kind of like aggregate stuff all together. A neural net might also make sense, but
it's a black box.
it's a black box. I don't. A phrase that I utter frequently with a silly tone of voice, which you're going to hear in a minute, is "put it in a neural net," which I don't really like. It's like a general modeling sort of setup because like I can't really understand it after the fact. Like this, while not super interpretable, I think is more interpretable than a neural net. And that's not to say that neural nets have no place in this at all, because they're incredibly powerful methods, right? Neural net regression and neural net classification, super powerful stuff everyone's using for something or another. So maybe in this, it wouldn't be too egregious because I already have some certain set of factors that I've selected. It's not like I'd be using it for, it's not like I'd be using it for discovery of some new statistical factor, some new statistical feature. That's where I'd be very skeptical about it because I have some set of things that I think is reasonable and then I could classify based on those. So now I'm considering it and it seems more reasonable in this case. I like it better now than I did 5 minutes ago. This, I think, this portfolio construction, this sort of aggregation of individual signals I think is a very good application of machine learning in general, just because it's, instead of using it to discover things, it's using it as just an extra classification or an extra regression tool from some other thing that we kind of preemptively understand at the beginning. And it makes it more reasonable to deal with it from there. Yeah. Ramble.
Did you standardize all the practices?
Yep. Habit. It's just kind of good practice to squash stuff when it's all over the place.
Is that way better like not to do it?
Maybe. In this case, Debus is sensitive to outliers, and something that's like $100 billion and 5% volatility, I'd much rather squash those than worry about whether that's going to be considered an outlier or not. It's really not more complex at all to just z-score it, so I don't see any real case why I wouldn't, especially if I'm dealing with so many disparate things. Yes?
I think, like you were saying, with decision tree, scaling, it's scaling different. Anytime you're building a decision tree, but a different algorithm, like a kernel root regression or something,
Yeah.
would require that for sure.
Definitely. I like squashing stuff. Yes?
Have you experimented with the different ways of estimating the factor of payoff? It looks like you're doing like quintile, kind of get that return. Have you thought about maybe like following Macbeth type regressions and then still see if that Debus approach leads to similar results?
What would you do with the output of the Fama-Macbeth regression?
Well, you have the factor returns or an estimate of the realized factor payoffs,
Yeah.
and you can, be able to, use that instead of using quintiles.
How would that be instead of the quintiles? Because I'd still want to go long on the things that have a high return and short on the things that have a low return. It still comes down to essentially the same idea.
Yeah, this is what approach I was thinking is not to the quintile, but you get the factor returns. You have short based on the factor exposures, but you'll have those returns as a way to include that in your Debus as a way of seeing whether or not you're.
Oh, okay. Yeah, so if I wanted to do that instead, yeah, totally reasonable. I mean, in this case, I don't actually do quintiles at all or break stuff into any sort of baskets until after I've predicted. So I'm passing in the pure feature. I'm not passing in any quintiles, any sorts of quantiles into Debus. That was just in the individual cases before I was dealing with it because I was showcasing the individual factors. When I'm then dealing with it in the aggregate portfolio, I'm just dealing with the pure factors and going from there. So I'm essentially doing that. Yes?
The signals within Debus are zeros and ones, not the ingredients. So
I think there are ones and negative ones. So we have the sign.
ones, like zeros, ones, or minus ones and ones.
Yeah.
What about the different gradient in between?
Whether there's if I want to classify 3 things instead of 2 things.
Maybe 20 things, yeah.
You can adapt things. I didn't want to because I'm lazy. And I don't remember if it's easy to do it with the base scikit-learn estimator. Maybe someone else can speak to that. But you could add in a 3rd thing to predict if you wanted to. I think it's easier to just try to predict between 2 things and then take the extremes, so I don't have to deal with much else. Cool. Thank you all for coming. Yeah.